Hello, everybody. This is Eddie Ghabour, managing partner of Key Advisors Group. And today I want to talk about what the market signals are telling us, and more importantly, some of the things that we're actually doing right now for our clients. And my goal today is to try to educate you investors out there that are managing your own money and getting all these conflicting signals and different points of view based on what you're watching on TV or what you're reading online that day. Please subscribe to my YouTube channel. I try to upload these videos every week with live actionable information in regards to when we're making changes and adjustments for clients. So right now, in our opinion, we are going to be heading into a very, very challenging environment from a stock market perspective. Okay, and when I say that, I don't mean just today. I mean, when we take a look at the next few months and we see some of the signals that the markets are telling us, in my opinion, it is clearly letting you know that we're going to be pivoting to a different type of economic environment over the next few quarters, okay? And some of the things that you've seen happening, because remember, the markets are very, very smart, okay? In my opinion, markets always correct before the data hits mainstream media, right? The same reason why markets usually go up before the economy recovers. A lot of times it goes down before the economy starts to go in the opposite direction, okay? So markets are efficient. They're very, very smart. And so trying to connect the dots in regards to some of the things that we've been seeing happening here over the last few weeks, I think is very critical in determining what the next move should be as an investor, okay? So from a big picture perspective, one of the things that we see is in regards to the VIX. You know, the VIX is the volatility index. And the VIX has really been spiking quite a bit here on a percentage basis. Even on some of the up days that we just had, the VIX did not drop as much as some investors would have expected it to. And so we know volatility has really increased, especially in the commodity space. That's the other thing we're taking a look at. Commodities have really corrected here. Not all commodities, but a lot of them. Look at oil, look at natural gas. So you got VIX spiking. You're starting to see commodities really come in and correct off of their recent highs that they had just a couple of months ago. And you're starting to see some interesting dynamics happening in the bond market, okay? You're seeing the long end of the rate stay flat to come down, and you're seeing the short-term rate really spike. So we talk about the spread between the 2-year and the 10-year bond. A lot of times that can tell you things. And right now that's really compressing, okay? And that's not good for certain parts of the market in our opinion. So the bond market is sending a clear signal. The volatility index is sending a clear signal. The commodity index is sending a clear signal. And you're also starting to see some small cap exposure stocks really get challenged in this environment. So what does all this mean at the end of the day? We think that right now, investors, obviously depends on your risk tolerance and your goals, should consider rotating out of your more of a reflationary trade that worked in the first half of 2021 and start looking at playing defense, okay? It should have been a great year for investors, depending upon where you invested. The market has seen some amazing recoveries off of the COVID lows that we saw, over a year ago, last March and April. And now as we're heading into the late fourth quarter, going to the end of December and going into January, we believe that the market is telling you that the economy is going to be slowing down. And when that economy is slowing down, at the same time the Federal Reserve is going to be tapering and possibly accelerating the tapering due to the inflationary risk, that's going to be very, very challenging, in my opinion, for risk assets, okay? So what we're doing as a firm right now is we are incrementally selling some of the high beta stocks that we feel are more sensitive to the economy. So we've reduced our energy exposure, we're reducing our small cap exposure, and we're actually increasing the quality of the portfolio. So what do I mean by that? One sector that we've been increasing is mega cap technology stocks. These are large cap companies that we feel have pretty solid balance sheets. And we think balance sheets are really going to matter next year. They didn't really matter in 2021 because it was a risk-on environment for most of the year. But now it's starting to matter. And that's why, in our opinion, you're starting to see low beta stocks really hold up well, even on down days. So we're increasing low beta, low volatility stocks in the form of using some ETFs that follow that space. We are reducing our exposure to energy companies. not because we don't like the fundamental story, but because we're trying to reduce the things that have the highest volatility heading into a year that, in my opinion, no one alive has ever seen before, okay? You have a Fed that has to unwind a balance sheet that has been extremely, extremely ballooning into an economic slowdown, okay? And again, I can't stress enough that that is literally the complete opposite of what we had in the beginning part of 2021. So if you feel like the environment's going to be the complete opposite of 2021, how in my right mind can I keep the same allocation strategy for clients going into that environment? So we're not. We're reducing small caps, we're reducing energy, we're increasing low beta, we're increasing high mega cap technology companies. And then the other thing we're going to be looking to do, it's too early in our opinion to do this right now, but probably in January, maybe February, we'll have to wait and see. We're going to start adding utility stocks, and we're going to add gold to portfolios, okay? Yes, these are boring plays to be in, but we're trying to find areas that we feel we can still get a pretty good risk-adjusted return when we're in a slowing economic environment, okay? And so a lot of times you'll hear the term flight to safety. And so we think when we start to see this environment that the flight to safety is going to be very favorable for utilities, for low beta, for mega cap technology, and possibly gold, and then cash. Don't forget about cash as an asset class. Because if we have this Fed accelerate their tapering while the economy is slowing down, in my opinion, that means the market would be ripe for a double-digit correction going in to the first half of next year. And what do I want to do if we see that correction? More than likely, we'll have to see that scenario at that time, but more than likely, we want to make sure we have dry powder to be able to buy that dip if we think it's a good opportunity. But you can't buy the dip, in my opinion, if you haven't set the table up for 2022. So the long and short of this is the market is sending some very clear signals now that we want to get ahead of. If you wait till the market corrects to start playing defense, you already missed that opportunity. So we're trying to not be greedy here. We're using the month of December to incrementally lower risk inside of our equity holdings for our clients. And again, trying to set the table up to have dry powder for a potential correction in 2022. And I've said this my entire career, and you may not agree with it, but this is my philosophy. I would rather de-risk early, even if I miss a month or two of decent market gains, to be prepared for what I believe is going to be a decent sized correction that I can take advantage of. It's been a great 2021. We want to book gains for our clients. We want to play defense because we feel like we're heading into a slowdown, and the Fed is the big wild card because they've put themselves in a tough spot. They have to taper, and they probably will have to accelerate their tapering. And God forbid if they announce a rate hike in the middle of a slowdown economically in the second quarter or third quarter of next year, you may want to look out in that environment. So again, we're trying to get ahead of it. I hope you enjoyed this video. More importantly, I hope you got some actionable items that if it fits your risk tolerance, that you can put yourself and your family in a better position to take advantage of what we believe is coming in the first half of 2022. Thank you and have a great day.